protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
Welcome to the Money Unleashed podcast. I'm Eric Johnson, joined as always by Kyle Allyn, and we are the vice presidents of Hoffman Financial Group. We bring you new episodes every Monday and Friday, so be sure to subscribe wherever you get your podcasts. What we're going to talk about now is big. It's how people invest, and there's two big ways you can do that, right? You've got active management, which we believe in, and then you've got passive management to invest your portfolio as well. Neither one of them are wrong. Everyone's got an idea of how to invest their portfolios, but let's talk about the differences between some of these. Let's dive into active management first, right? Or active investing. So it's basically a hands-on approach, right? So active investing involves making frequent investment decisions such as buying and selling securities with the goal of outperforming benchmarks such as like the S&P 500, for instance, which if you're in stocks, you want to base it off of S&P 500. And the goal is to achieve higher returns than the market average. So if S&P 500 gets at 10 and you get 12, you've won, right? You've done better than just being in the S&P 500, let it bounce around. And there's methods to this. So active investors typically conduct research. They look at individual companies, industries, market trends. They're identifying valuations. Is it overbought? Is it oversold? Do we have high growth potential? Are there dividends involved? And I guess an example would be, individual stock picking versus being inside of a mutual fund or an ETF, right? So that is active management. We believe in that and repositioning on a quarterly basis and on an as-needed basis as well, too. Then you got passive investing. That's kind of a hands-off approach. So that means basically picking an investment, just dumping money into it and or just picking it and just watching it, move over time. And that has the ability to work as well, too. But the world changes quickly. In our opinion, you need to be able to change quickly with it, right? So what's the goal of this, right? Is to match performance of a benchmark or an index rather than trying to outperform it. So you're just trying to do the status quo. Like if the S&P 500 makes 10, you've made 10, you're a happy camper. Now, some methods to this. So passive investors typically invest in index funds like ETFs, S&P 500. I mean, you could get into, we mentioned the spiders earlier, like that's a way for passive investing. And when you're looking into these types of indices or index funds or ETFs, you're looking for lower costs because there's going to be a cost to having this passive investing because someone's doing the ins and outs of it for you. You have lower risk because you're more diversified theoretically inside these ETFs, and then also tax efficiency, right? So with fewer transactions, buying and selling, for instance, in a brokerage account, you're eliminating long and short-term capital gains when you're basically just going long-term capital gains on this stuff. So why don't we talk about why we like active investing versus passive investing, Kyle?
Yeah, so one of the things that I found was the most common actively invested, so active management mutual fund in the world is American funds, what they call the Growth Fund of America, AGTHX.
Okay.
Right, so sometimes you can have a mutual fund that's actively invested. In this case, there's about $296 billion in this thing, so it's extremely common. The other thing I found, and I thought this was really interesting, so you've got the most common mutual fund as far as active management, and then, of course, the most common investment advisory team, which would be Edward Jones. So Edward Jones has net revenue of $14 billion, ranking them 303 on the Fortune 500, and this company has a net revenue of $12.27 billion in 2022. And so what I wanted to point out here is Edward Jones has a revenue sharing agreement with American funds, and they're receiving $315 million in that revenue sharing agreement. So we've got a lot to unpack here, right? Mm-hmm. So we're talking about active versus passive management. And then the other thing that we're talking about is the prescription from the largest investment advisory company, Edward Jones, and how often they're recommending something like American funds. So there's two things here. Is active versus passive better? And then why are we being recommended the things we are by our advisors? So I'm going to take the first one.
That's a great point.
Yes, sir. So the first thing I found was if you look at the S&P 500's basic SPY, right, so a really basic ETF, this would be an extremely passive choice. If you look over the last 5 years, the return was 111%. If you look at the active management mutual fund from American Funds, AGTHX, the performance was 104. So it lost. It was not able to keep up with the passive management. So I would argue that not only is there a debate within active versus passive, there's also a debate within active managers who is succeeding. So if you take all of this and you say, okay, this is really confusing, Kyle. I'm hearing that certain advisory teams are recommending active. Some are saying passive. I'm hearing you say maybe the passive works sometimes. I heard Eric earlier talking about how active can be more successful. Here's how you simplify this long-winded, complicated discussion. And it's really easy. What is your benchmark?
Yep. What are you basing your success on?
Totally. You heard me just do that. I said instead of assuming that active management through the American Funds mutual fund was working better, we held it accountable. Okay? In the last 5 years, when we look at the passive management from the basic ETF of SPY, we can see that it beat the active management. There are times that active management makes a lot of sense. There are times that passive management makes more sense than active management. The point here is really simple. If you invest money and you work with a team or you work by yourself investing that money, you have to set a benchmark and hold that money accountable. Now, in the world of benchmarking, it becomes confusing because let's say you had 50% of your portfolio in bonds.
Yep. You can't use S&P 500.
You can't use the SPY as a marker for that because the SPY, the Standard & Poor's, the S&P 500, is totally in equities.
It's bond-free.
It's bond-free. So then you say, okay, what would be a way to do that? Well, I'll give you two easy ones. If you're an aggressive investor, kind of 80, 20, 70, 30, you can use iShares, what they call AOA. It's the aggressive allocation from iShares. So that's a very passive way to do it. If you can outrun that with active management, you've done a good job. You can also use the AOK, which is iShares conservative management structure through an ETF. So if you can outrun that and you're conservative, kind of 50-50, 60-40, then you've done a good job. So the other way I'll give this out, and I always give this to clients, there's an easy little website. It's called IFA.com. So indexfundadvisors.com, and it allows you to break out your benchmarks in 5% segments. So do you have 25% in stocks? Do you have 45% in stocks? Do you have 65% in stocks? Or do you have 100% in stocks? The point here with this discussion is there are people that succeed at a high level in passive management. There are people that succeed at a high level in active management. Whether you're managing this through those two strategies, whether you're managing it by yourself or with an advisor, you have to hold both the investments and the advisor accountable. And if you don't have an established benchmark, you can't do that. And it amazes me how often I ask that question. Someone's sitting in my office as a prospective client. I say, hey, what's your benchmark? And they go, I don't know what you mean.
Yeah, what are you talking about?
And I go, how long you been with your advisor? Oh, 15 years. So for 15 years, at least once a year, is sitting down with your advisor and your advisor saying, here's what's happening in the accounts, but you have nothing to measure it to. It's like jumping in your car and saying, you know what we're going to do? We're going to drive to Charlotte. And then all of a sudden you find yourself in Jacksonville because you didn't look at a map, you didn't look at a GPS. Well, if you're just driving aimlessly in the car, it's not surprising that you ended up south when you were trying to go north.
Yeah, you're never going to get to your destination if you're not measuring yourself. It's like, when I played football, if I wasn't, benching 400 pounds and moving guys out of the way, I'm not going to play.
Subtle flex, by the way, I cannot bench 400 pounds.
I did it for a short period of time.
I felt really small in this room, buddy.
I can guarantee you this. I'm not doing that anymore, right? That was back when I was young.
How do those pectoral muscles and those shoulders feel if you pick up 400 pounds these days?
Oh, yeah, my goodness. No, I need help. I need like two other guys to do stuff like that.
All right, I digress.
It's okay. But listen, it's about measuring and getting yourself better. Me getting my girls to school on time. You got to measure what time you got to wake up so I can yell at them to brush their hair and their teeth every single day. Where are your shoes? You got to have enough time allocated for that. If you are going to drive to Charlotte, right, you need to look at things and figure out, okay, you get onto your Waze or you get onto your GPS and you figure out how long is it going to take us to get there? What's the best route to get there? Nothing changes when you're looking at your portfolio. Like, how do I want to get to the levels of wealth that I want to get there? Do I want to do it through diversification and passive management, or do I want to hit the ball a little bit farther and get some active management? Now, what I'll say is that if you're going to do active management, it's better if you have a fiduciary advisory team doing this for you, right? Because a lot of people I get the pleasure of sitting with are either physicians, they're attorneys, they're mechanics, engineers, and they're really experts at their job. But it's very difficult to be an expert at your job, let's say as an engineer, right? And then also be an expert on the stock market and how to take your money and make more with it as well too. And I tip my hat to people who do this on their own because it's not easy. But what happens is you typically get to a level where you're like, oh crap, if I'm wrong and I lose $100,000, I'm gonna have a really hard time looking at myself in the mirror while I brush my teeth, right? So it's good to have a fiduciary advisory team, and we are, and there's a lot of people like us throughout Atlanta, but making sure that you can have somebody else watching it for you who's versed in how equities work, how other investment vehicles work, and how it's going to involve your portfolio. Like Warren Buffett says, if you're an average investor, like S&P 500 is a great way to make money. And he says that, and I believe everything that Warren Buffett says. However, if you look at Warren Buffett, he does the exact opposite. If you're looking at Berkshire Hathaway, he's got about 30 different stocks. He's a stock picker, right? So there's different ways to have it work. And basically what he's telling you is if you don't know what you're doing, do the S&P 500. If you do know what you're doing, now you can start picking certain equities and you can, trim on the way up and buy on the way down.
And to know is to test. So you have to have a benchmark, right? So what Eric's talking about is understanding that there are successful metrics within both passive and active management. But to understand what success is, you have to have a measurable benchmark to give you that clarity. And if there's anything that we do is give you the logic and clarity in emotional moments to understand what is successful, what is working, that gives you the confidence to move through retirement without all the drama. So there are so many people that they're thinking, maybe I'm succeeding, maybe I'm keeping up with my benchmark. Enough with maybe? Let's know. We have the ability to sit down with you and give you the clarity to find out whether you're passive or active, if you have found success, and if you're heading towards a successful future.
That's right. Hope is not a financial plan. It's just not. And I got great news for everybody. We do this at no cost and no obligation to you. If you got to put together one of these plans or you got to figure out where your benchmark is or how you get to next levels of wealth, we can help you with that with a portfolio x-ray. Either give us a call at 404-640-5511. That's 404-640-5511. Or you can go online and find us at unleashyourmoney.com and simply mash the button Portfolio X-ray. We can take a look and figure out what your benchmark should be and how you can outperform that benchmark to hit next levels of wealth. And the best part is, guys, we do this at no cost and no obligation to you. That number again is 404-640-5511, 404-640-5511. And again, you can find us online at unleashyourmoney.com.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.